Kinder Morgan. Group 5, presented by Aaron Costellar, Jed DeCamp, Trevor Ellis, Roland Murillo, and Corey Hibbard. Kinder Morgan was the 10th largest U.S. leveraged buyout. The firms involved in this buyout were Goldman Sachs, Citigroup Market, Wachovia Securities, Merrill Lynch, and Deutsche Bank at $22 billion. Kinder Morgan was established February 1997 with 175 employees and an estimated $325 million in value. The company manages 80,000 plus miles of pipeline and 180 terminals on the North American continent. It has a current estimated value of $110 billion. Kinder Morgan is dedicated to consistently delivering value to their shareholders and keeping them informed. With more than 80,000 miles of pipelines and 180 terminals, Kinder Morgan is the largest midstream and the third largest energy company. There are 4 ways to invest in Kinder Morgan, as listed here: Kinder Morgan Energy Partners, and Kinder Morgan Management, and lastly, El Paso Pipeline Partners.
As you can see, Kinder Morgan is broken up into 5 segments: pipeline, products from the pipeline, CO2, terminals, and Kinder Morgan Canada. Kinder Morgan is the largest natural gas transporter and largest storage operator in North America, with over 80,000 miles of pipelines. Through these pipelines, they transport over 2 million barrels per day of gasoline, jet fuel, diesel, natural gas, liquids, and other fuels for more than 8,000 miles of their pipelines. Kinder Morgan is the leading transporter and marketer of carbon dioxide in North America, delivering approximately 1.3 billion cubic feet per day of carbon dioxide through their 1,300 miles of pipeline. They're also the largest independent terminal operator in North America, with more than 180 terminals that they use to store their petroleum products and chemicals and handle the bulk materials like coal, petroleum, coke, and steel products. Kinder Morgan's Canadian operations operate a number of pipeline systems and terminal facilities in Canada. In May of 2006, the investment group originally made an offer for $13.5 billion. The offer was for $100 per share, which was an 18.5% premium on the stock price of $84.41. This initial offer was rejected because Kinder Morgan felt it was too low. Then 3 months later, in August of 2006, a second offer was made for $15.2 billion plus $7.2 billion in assumed debt. The increase was a result of increasing purchasing each share for $107.50. This was a 27% premium over Kinder Morgan's closing price when that initial offer was made back in May. Skeptics argued that the offer was too low. Mr. Kinder believed in the company and wanted to privatize. He claimed that the shares were discounted because they had traded at $103.75 in 2005. The investor group included Richard Kinder, who held 20% of the company, Fayez Seraphim, and Mike Morgan, who are 2 current directors at Kinder Morgan. Goldman Sachs Capital Partners, which was the equity business for Goldman Sachs, the American International Group, an insurance company, the Carlyle Group, which was an asset management company, and Riverton Holdings.
Some problematic conflicts were Kinder Morgan management approached Goldman Sachs for alternatives to enhance shareholder value. Initially, management conducted this process apart from the board. During this process, Goldman Sachs requested to become a principal investor in the buyout option. Initial negotiations with Goldman were held privately. This was done without the board knowledge at the time. Goldman Corporation had interest on both sides of the offer and deal because, as a significant investor in Kinder Morgan and as a potential investor in the LBO group, management is incentivized to pursue their own buyout as opposed to potential market suitors. The reasons for the buyout and going private included the following. It was to reduce taxes, minimize risk, increase reputation and appeal of the company, complete ownership control, and increase future management flexibility. In 2006, there was a class action lawsuit filed against them, claiming a breach of fiduciary responsibility. Shares were valued at $107.50 at the time. The suit was settled in November of that same year. In November 2010, shareholders were paid $2 per share, and the total payout to the shareholders was $200,000.
On February 11th, 2011, an IPO was issued and was the largest in U.S. history, raising $3.3 billion. Initially, the offer was between $26 and $29 a share, but due to demand, this raised to $30 a share. The underwriters of the IPO were Goldman Sachs, High Star Capital, and Riverstone. Richard Kinder, the founder of Kinder Morgan, withheld his shares, showing his belief in the company and the potential to improve it. Private equity investors collectively invested $14.5 billion, and the IPO was valued at $20.2 billion, meaning that the return for the investors was a 46.2% return. Here are some ratios, financial ratios for Kinder Morgan. Worthy of note are the total revenue, which increased from 2009 to 2012 significantly. The growth period from 2009 to 2012 increased, as well as the gross profit margin percentage. The leverage ratios, as it shows, the total debt equity is 175.7%, and the total debt capital is 63.7%. Long-term debt to equity, 159.7%. Long-term debt to capital, 57.9%. Total liabilities to total assets, 69.6%. Total debt to EBITDA, 6 times. The current ratio being 0.5 and the quick ratio being 0.4. Here's a comparison to their direct competitors. KMI is Kinder Morgan Incorporated, EPD is Enterprise Products Development, and WMB is Williams Companies Incorporated. As we see, the stock price of Enterprise Products Development is the highest at $44.80, and subsequently their market capitalization is the highest in the industry, and Kinder Morgan coming in at $19.7 billion, behind EPD but ahead of the industry average. Revenue for Kinder Morgan is $8.2 billion. EPD is the highest with $42.31 billion, the industry at $1.57. Gross margin percentage, Kinder Morgan leads the industry with 39.71%. This is the end of our presentation on Kinder Morgan Incorporated, one of the largest leveraged buyouts in United States history.